On behalf of Pune branch of ICAI Rishikesh Badve, the treasurer of the branch, welcome all of you to this international tax series, which is conducted by the Pune branch. Today is day 4 of this series, and we have already witnessed excellent sessions from 3rd of this month during this series. So with this brief introduction, I request the chairman of Pune branch, CA Rajesh Agarwal, to offer his opening remarks, please.
Thank you, Rishikesh. Warm welcome to today's faculty, CA Mitesh Thakkar sir, and also all the participants. Good evening to all of you. This series we have structured and we received very good response for the series. Even for the topic international taxation, we have very good response. Thank you to all the participants for active participation and your response. I thank Mitesh sir for accepting our invitation to enlighten us on the topic cross-border transaction. Thank you, sir. I thank all the participants for your active participation and thank you, Rishikesh.
Thank you, sir. So before we hand over the charge to our today's speaker, I would like to have a brief introduction of CA Mitesh Thakkar, who is today's faculty. Mitesh Thakkar is a director at EY in the tax and regulatory services based out of Pune. He is a commerce graduate and a chartered accountant, and has over 14 years of professional experience and in the corporate tax and regulatory matters across a wide range of industries. His professional experience includes corporate tax and regulatory matters with special focus on the inbound and outbound investments, group restructurings, location strategy. Mitesh has also advised clients in a wide range of industries with specific focus on clients in the technology sector and the automotive sector. He has also advised clients in technology sector on various issues like taxability of software licenses, equalization levy, PE, permanent establishment related aspects, location planning and consolidation of operations, etc. He has also led multiple advisory and strategic projects for clients, illustrative implications of repatriation of profits, consolidation of operations of India entities, tax refunds, ESOPs, outbound restructuring, availability of benefits under new 15% CPR regime, etc. So I feel that for today's topic, CA Mitesh Thakkar is the appropriate and apt faculty to deliver a great speech. So I once again welcome CA Mitesh ji and kindly hand over the charge of this webinar to him. Thank you.
Yeah, thanks, Rishikesh ji, thanks Rajesh ji. Good evening to everyone. So maybe let me start with wishing everyone a happy Hanuman Jayanti. So thanks for joining on a auspicious day, taking out time to attend this session. And we do have a Hercules task like Hanumanji had of dealing with a very heavy topic. So I assume that most of you would have attended all the sessions which have happened till date, where you would have got some background on how the cross-border transactions work, what is permanent establishment, and the earlier speakers would have given you a lot of information around that. Some of that information would be relevant in the topic which we are discussing. So I look forward to interacting with you all in this session. And like Rajesh ji mentioned, we would be happy to see and have this session as an interactive session. So as we move along, if there are any questions, you can feel free to put that in the chat box either during the session or at the end of the session. I will put in my best effort to ensure that I'm addressing your queries. Maybe let me just quickly run you through what is the agenda, how we plan to run this session. So, the topic is very vast, is vast and also ever changing, because as everyone would appreciate, digital economy is moving at a very fast pace. When we were in schools, that time nobody had, even access to mobile phones. And today everyone is hooked onto social media, whether it is, Facebook, LinkedIn, or gaming apps. So the industry has moved at such a rapid pace thanks to the telecom revolution which has happened across the globe, specifically cheap internet in India. We see that these business models keep evolving at a very fast pace and keep changing as we talk. So, with that background, what I plan to cover is what we see in the industry as various business models, because before we understand the technical nuances, we need to just broadly understand how the business has evolved over a period of time. Then we will spend some time on understanding what happens in terms of taxability under the domestic tax law and the tax treaty, specifically with respect to software licenses. And everyone would be aware that there was a landmark ruling from Supreme Court in 2021. So what was explained by Supreme Court in that ruling is something which we will cover, along with the controversy which were settled by the Supreme Court in that ruling. And also spend some time on what is the impact of that Supreme Court ruling on the changing business models. How do one look at it, whether we are saying that this ruling now settles everything forever, or we still have some open points. Considering the fact everyone is aware that the Supreme Court said that the software license income is not taxable in India in view of the treaty provisions. How do we look at equalization levy provisions, taxation around that? Where do we stand today? And we will also spend some time on whether equalization levy is here to stay, or how is the global world looking at it? How is OECD and India looking at taxing digital economy going forward? And then we will also spend some time on 2-3 case studies so that you can understand the practical implications of these learnings in terms of real life situations. So that's what we plan to cover in next couple of hours, and I hope it will be an enriching experience for everyone. So quickly moving ahead to some background. As we today, all of us know that digital economy has been moving at a very fast pace. And what is complex about the digital economy? You would have studied in the P session in terms of the various types of P, whether it is a fixed place P or whether it is agency P, service P, all these types of Ps which you would have discussed typically entail some kind of business activity in form of physical presence, conclusion of contract, rendering of services through physical presence in India. Now, what we see in digital economy is very different, right? Where we see that people really don't need anybody on the ground. Their physical presence is in form of our mobile phone, a website. So a lot of activity happens through virtual presence rather than physical presence. And that is where, the business models have kept evolving at a very fast pace, and the taxation, has always been catching up. So I will just spend some time on how the business models have evolved, and then we will spend some time on how taxation is catching up. So, typically when we look at when we were, in school, we used to see that we used to install software through a CD. Typically you would have a very simple example of Microsoft Office. You would purchase the Microsoft Office license from a vendor, put it in your CD drive, and you would install. That's like a simple single user end user model kind of thing, where you buy the software license, you install on your computer, and you start using it. And typically when you install, you sign something called as an end user license agreement, which is a very important document. As we move along with the discussion, you will realize that. So no, that was the conventional business model for a typical end user. But at the back end, these software companies again had a variety of business models when it came to sales, because they didn't have only individual buyers like us, but they also supplied these kind of licenses to institutional players. And to ensure that you are competing well in the market, you therefore had various other models, like, you would typically have a reseller or a distributor in India. Then you will end up having some kind of business models where you will have flexibility of customizing your software to meet buyer's requirements. So, if you have a solution which can be integrated into SAP, then you will provide that flexibility to the customer where you will do customization. Then you had the IBMs of the world, where what they used to do is to ensure that their sales are growing at a fast pace. They started embedding softwares into their hardware, like a laptop, for example, and they started selling, a bundled product where they said, we will have a product which has embedded certain pre-installed products which typically you will use, and that's the offer from our side, which where you get those products at a cheaper price. So now you had these various kind of conventional models which used to work. Another typical model which you would have seen typically when you would have done, especially people who are in practice or in industry, when you would have seen remittances in a MNC kind of situation, the group also incurs certain cost at global level, and then they recharge the Indian company with respect to the relevant cost which pertains to India employees. So, these were like few examples which I could think of, and I'm sure there will be many more examples which will come to your mind, which typically kind of, I would say, fall in the bucket of conventional models. Now, moving ahead quickly to see how things are evolving at a very fast pace, and how things move quickly in the new age digital world. Today we hear all these fancy words, right? Software as a service, platform as a service, infrastructure as a service, and there will be chat GPT, so many things which we are hearing today. And how is the global tax forum looking at it, whether it is OECD, G20, or for that matter, how is industry also looking at it, is another interesting question. And again, just to give you some perspective of what typically we would classify each business model into these buckets. So let's say today, when I am selling a software license to you, but I host it on a cloud which is owned by Microsoft, or let's say even Amazon Web Services. Typically, then I would call it a software as a service model, because I am not really installing any software on your computer or a laptop, but you are accessing the software on cloud. So now that is what typically is considered as a SaaS model, and we will in one of the case studies discuss how to evaluate tax implications in such kind of situation. Then when Amazon is providing the cloud service to these kind of software companies, we would typically call it either as infrastructure as a service or platform as a service. And you could also have a situation where, let's say, Microsoft owns the platform or the cloud and also hosts its software on those clouds, and that typically could again fall in the second category, which is platform as a service. So again, these definitions are not sacrosanct. These are nomenclatures which are used by industry to get premium pricing on their products, and therefore it is interesting to know these concepts. You will find that these are used interchangeably and flexibly by industry players or the sales team specifically of these software vendors. But you have to keep your eyes, ears, and open for these terminologies, and be ready to deal with tax implications if these kind of models come across for discussion before you. Now, another interesting aspect is that taxation of digital economy has been very complex because of the points around permanent establishment and few other things which we discussed earlier. So what is happening globally is that G20 and OECD, along with more than 100 countries, have been working at the back end to come up with a way forward on how to tax it, because they believe that there is a significant tax leakage today in terms of these transactions, and the jurisdiction which is actually having customer base is not getting fair share of revenue. And in fact, even the developed countries, which are the countries where these software companies are based out of, feel that these entities have structured their business in such a fashion that they are also not getting fair share of revenue in their country. And earlier, they called this program as Base Erosion Profit Shifting Plan 1 or BEPS 1, where they had come up with 15 action plans, and action plan number 1 was on digital economy. But in that action plan number 1, there was no consensus. They debated a lot on how to tax digital economy, and after a lot of debate, they eliminated various options which they thought through, and they said we will come up with a better plan. That is where we had something called as BEPS 2.0. And in BEPS 2.0, we have 2 action plans, Action Plan 1 and Action Plan 2. Action Plan 1 is where we'll discuss something around how digital economy will be dealt with from a taxation perspective for large MNEs. Again, it is not covering smaller businesses. As of now, it is focused on large multinational corporations, but it's interesting to understand in some bit of detail in terms of how the global tax governments are looking at taxing these kind of economies. And interesting to notice that in that position paper or that action plan, they have kind of classified these industries into 2 buckets: consumer facing industries and automated digital services. So, down the line, maybe after 2-3 years, you will start hearing this terminology more, where digital economy will be classified into 2 buckets: consumer facing business and automated digital services. And we'll discuss some bit of it as we move along. So that's like a broad overview of how the business is evolving at a very rapid pace. Everybody needs to catch up. We know that the Indian government is also making a rapid pace in terms of implementing technology and also bringing up changes in the domestic tax law with respect to taxation of digital economy. So it's a very exciting place to be in if you are either in the industry or a tax consultant, but you also need to spend a lot of time understanding nuances and taxability of these kind of transactions. So that is where we are today. And with this, I will maybe quickly move on to how we look at taxation of these kind of income streams more in the conventional business models, and also more from a perspective of domestic tax law, which is your typical royalty FTS provisions. And also we will spend some time on interplay with tax treaty of royalty FTS, taxability of these contracts. And then the new animal on the floor, which is equalization levy, which was introduced a couple of years back. And what is exactly the taxation regime under equalization levy, where do we stand today? And then we will spend some time on the way forward. So I'll just quickly spend 2 minutes on this slide. So today, when we are seeing, typically when you are as an industry representative or a practicing chartered accountant, either cases, you get inquiries about cross-border transactions where either a non-resident entity is selling something to you in terms of a software license, or there is a remittance involved. There is a new contract which is proposed where again a non-resident entity is involved. So all these kind of situations is where all these points which we are discussing will become relevant. Some points like equalization levy will be relevant only to the non-resident entity. So if it is your group company, then it becomes relevant. Otherwise, that point is not so relevant if it is a third-party transaction. Royalty and FTS is all pervasive, and therefore it becomes a very important aspect in those transactions. So really what we are evaluating here is typically when there is a software license sale, whether it is in the traditional business models or the new age business models, the underlying principles don't change, and therefore typically you will have a end user license agreement. And what we will have to do is evaluate in a bit detail whether such transaction fits into the definition of royalty under the domestic tax law or the tax treaty. And if yes, then what are the ramifications? Obviously, you have already understood various other compliances from a 195 perspective, which you will have to follow. So, those principles which you have learned in the earlier sessions will continue. This is more with respect to the taxability position on the remittance which is involved on these kind of payments. Typically, also what you will see is that most of these software license or any other digital transactions will not only involve just licensing for end users, but it will also involve post licensing support. Because most of the softwares you will have, there is a possibility you may have some glitches, you may need upgradation, you may need implementation support. So there will be a team from the service provider side who will provide you support. Therefore, typically you will have a situation of bundled contract either with hardware or with services, or separate contracts for additional warranty or customer support. So that is where it also becomes important that we evaluate fees for technical services in these kind of contracts. So that is how I would look at or summarize it, and we will get into more details as we move along. And just from a completeness perspective, if the non-resident entity is specifically your group entity, or you need to take some declarations around equalization levy, that is where I thought it would be apt to cover equalization levy also for maybe 10-15 minutes. We'll discuss that as well in terms of what is the law around it and what is the sequence, whether I need to look at equalization levy first or whether I need to look at taxability of that particular contract as royalty or FTS. So we'll cover that aspect as well as we move on. Moving along now to taxability of these kind of contracts, typically under the definition of royalty. So, what exactly is defined as royalty, and we'll just spend some time looking at the definition of royalty both under the income tax law and then under the few tax treaties in terms of what are the differences and why did this matter travel all the way to Supreme Court. What are the reasons for that? So you can see on the slide that the main crux of debate which comes when we look at royalty taxation is explanation 2, where if you look at the language, it says that if in a transaction there is transfer of all or any rights, including granting of license in respect to or in respect of any copyright, literally artistic or scientific work, then that transaction could be subject to royalty taxation. So when we are looking at any agreement in digital economy, what we have to therefore evaluate from a royalty taxation perspective is that agreement resulting in satisfaction of this condition, that is the seller transferring all or any rights in respect of the copyright embedded in that software or the product which the person is selling. And this is the crux of the Supreme Court ruling as well, and we'll spend a lot of time understanding nuances of this. Now, what the government obviously has been doing is they have been seeing what has been happening, and before the matter reached Supreme Court as well, there were a lot of judicial precedents from various high courts which were rendered in context of various business models. And there is this famous amendment which had happened in 2012, which was done by the late Pranav Mukherjee when he was the finance minister. There was a ruling in favor of taxpayer in context of satellite business by Delhi High Court, and the government felt that that ruling was not appropriate, and therefore they went ahead and made a lot of retrospective amendments in the domestic tax law, which is section 916 and 917, both royalty and FTS definition. And what I've reproduced is, as part of those amendments, where various amendments were done to nullify the ruling, Delhi High Court ruling in case of satellite business, they also in the process noticed that on computer software as well, there are a lot of positive rulings in favor of taxpayers. So they introduced this explanation retrospectively to say that in case of computer software, even if you transfer all or any rights, including granting of license, that would constitute royalty. So they kind of close the door of any argument under the domestic tax law for these kind of contracts. And again, this is an interesting development. We will spend maybe 1 or 2 minutes when I discuss the Supreme Court ruling in detail. And before we kind of get into more nuances, what I have also done is put up a couple of slides on how does this definition of royalty look like in the tax treaties? And I have two slides on it. One slide is covering major countries which typically we would transact with, which is your transactions with all the European countries, USA. So, these are like uh, generally the technology partners where we see technology flowing into India. And therefore, this is the bucket where you will see most of the litigation or most of the transactions which you will come across on a day-to-day basis. But there is another bucket which is also interesting, and I'll just spend time on that after we discuss this slide. So again, the definition prima facie looks similar, but if you look at it, there are small variations. And let me explain those variations. If you look at the definition here, you will note that it does not have a comma after copyright. If you look at the definition which was there on the earlier slide, it had in the explanation too, it mentioned that in respect of any copyright, literally artistic or scientific work, whereas in the definition under the tax treaty, it says consideration for use of or right to use any copyright of a literally artistic or scientific work. And this distinction was also noted by Supreme Court in the ruling, where they said that generally copyright as such is not something which you can give a right to use or you can transfer. Copyright itself is a right of a literary work or a scientific work. So typically literary is more of to say that some author has written a book and then you give somebody a copyright to publish that book or sell the copyright to a publisher. Scientific work will cover computer software, artistic work will cover your movie, your Netflix, any other online content or any artistic work in that, for that matter, even a painting. So the way it was defined in treaty was apt vis-a-vis the definition in act is a bit incorrect to that extent. And they also highlighted that that correction was done by government when they had put in the draft direct tax code in 2010. But unfortunately, they didn't make a corresponding amendment in the act. Of course, that doesn't impact the tax position per se, but it's just a small nuance for everybody's reference, which I wanted to highlight. So if you look at this slide, this is the definition which you will have to deal on a day-to-day basis when you're dealing with such kind of transactions, because majority of most of our 79 tax treaties cover this definition. But just from a completeness perspective, what is the variation in few other treaties? Like for example, if you look at the next slide now, few treaties like Russia, Morocco, and Romania have a bit of different language where they've also used computer software program in this definition of royalty. Again, the question which will come to everybody's mind is, does that really mean that when we are making payment to a Russian entity or a Morocco entity with respect to an end user software license, will it automatically become taxable? That is something which I will keep as a question to be answered when we discuss the Supreme Court ruling. But that's a small variation which I wanted to highlight in terms of how the tax treaties look like. So predominantly, major tax treaties are something which don't have computer software as the language. It's only few treaties. Again, if you look at the names, you would generally feel that you will not have transactions with these treaties more often. It's more on exception basis where you will see these kind of countries because they are not known for being digital powerhouses. Typically your digital powerhouses are the Americas of the world and the European countries. So those are the countries where you will typically see software licenses being bought from. So and that's like a fair summary of where do we stand. Now, what I intend to do in next maybe 10 minutes is to discuss the landmark ruling of Supreme Court, because that forms the basis of you taking tax position on these kind of transactions with respect to specifically royalty taxation on a day-to-day basis. And what exactly did happen before the Supreme Court in 2021. So just to give you a background, and I'm sure most of you would have read about it, but it is good to refresh. This Supreme Court ruling, why it is considered as a landmark ruling, not only from a perspective of what they delivered, but sheer volume which was present before Supreme Court. It entailed more than 100 taxpayers cases which were in litigation from 1990s till maybe 2018. So it entailed batch of maybe 108 or more than that taxpayers. It entailed parties like IBM, Microsoft, Samsung, so all the big players who today we see prominent industry players in this space were party to that litigation. There were few companies from Pune also which were party to this litigation. So we have few names from the local market as well. In addition to that, it entailed around 18 tax treaties, which is also listed in the Supreme Court ruling. The judgment itself is around 226 pages. So if you have to really get mastery on taxation of software license, specifically the conventional business models, you have to just read this ruling and you will kind of have a kind of thesis available with you to master on. And I did spend some time reading this when I was preparing for this session. So I will also kind of spend some time on sharing my learnings, because this law is so complex that every time you read, you kind of learn about a new dimension. So that's like the magnanimity of this ruling, and therefore it's a very celebrated ruling. We do know that department has kind of filed a review petition against this Supreme Court ruling, which is pending before Supreme Court. But going by the past trends, we have seen that generally Supreme Court doesn't disturb these kind of rulings, but you never know. So as of now, according to the tax department, this matter is still something which is subject to challenge. But since we have a ruling on merits, we can safely say that this is the law of land till something happens on the review petition. So today, when we deal with these kind of transactions, we have to look at what are the principles coming from the Supreme Court ruling. I have few slides on fees for technical services, which I'll touch base later on as we move along, because this is just an overview of what the FTS provisions look like. So coming to the Supreme Court ruling now, what were the issues involved and what were the key takeaways. And I've just given an overview of what were the key takeaways here so that the context is understood. When we discuss the royalty definition, we did spend some time on the word copyright, and that has been the big debatable issue when it came to taxation before the Supreme Court as well, where there were two high courts. One was Delhi High Court, which in batches of rulings held that whatever business model was before Delhi High Court, they said all these business models were nothing but sale of copyrighted article, and that it did not really result in any transfer of copyright. Whereas we had Karnataka High Court, which said that even if an end user is given a right to use a copyrighted article as an end user, or for that matter, if he has a right to make a backup, that is good enough for it to be taxable as royalty, both under the domestic tax law as well as the tax treaty. And that is where Supreme Court had to discuss in detail what is the distinction between copyrighted article versus copyright. And eventually, Supreme Court kind of held this issue in favor of taxpayer, and it also relied on the celebrated TCS ruling, which was in context of GST, where Supreme Court had held that when you have these kind of end user software licenses being sold by one party to another, it is nothing but a sale of goods and not really transfer of any copyright. And we will spend some time more understanding these nuances as we move along in subsequent slides. Another or few other interesting observations were also made by Supreme Court, where they said that you have to look at what is defined as royalty also under the double taxation avoidance agreement, and not only under the domestic tax law. And here, why I'm saying this is because department kind of heavily relied on the fact that Finance Act 2012 had amended the definition of royalty with those explanations, and that too retrospectively. And in absence of a definition of copyright in the tax treaty, one has to take recourse to the definition under the domestic tax law, and therefore on a conjoint reading it will become taxable under the tax treaty as well. But Supreme Court kind of disagreed with that argument and kind of specifically said that if that was the case, then ideally you should have gone ahead and renegotiated the tax treaties to get that definition included. In fact, the fact that you introduced these retrospective amendments saying that this was already a law, then in the interim period, whatever tax treaties were signed, why did you not include this in the definition of those tax treaties? Those definitions also were similar to what were signed, in past. So they kind of did not accept that argument of tax department. There were a few other interesting observations also with respect to withholding, which I'm sure would have been covered in the earlier session, but just from a completeness perspective, I will quickly update you on that without spending too much of time. There is always this debate in context of composite contracts, especially when you have a computer laptop being sold with a computer software. In case of a composite contract, whether I can do withholding, applying my own judgment, or whether I have to necessarily approach tax department under 195(2) or a 197 lower withholding certificate. Again, there they kind of said that it is not mandatory that you have to approach. It's an option, and the taxpayer is free to take his position, and department will always have an opportunity in assessment to challenge or review that position. And therefore, you cannot always have a situation where mandatorily the tax assessee has to approach department for a lower withholding certificate or to determine what is the quantum of amount on which tax is required to be deducted. They also specifically upheld or distinguished the Pilcom ruling. The Pilcom ruling, again, as you would be aware, had said that it is mandatory in context of payments to sportsmen, that if there is ambiguity, you have to approach tax department. Again, that is not relevant for 195. So it is not necessary for you to approach tax department, and you can take a tax position basis your wisdom, and whatever the chartered accountant who is certifying, he can also take an independent tax position. So I'm sure this was discussed in detail in the earlier session. So this principle was also kind of reiterated or reaffirmed by Supreme Court in this ruling. Now, moving ahead quickly in terms of what exactly the Supreme Court do in this ruling, and I'll just spend some time on what kind of business models were present before Supreme Court. Like I discussed, there were more than 100 taxpayers whose appeals were kind of clubbed and heard together, and there were some 18 tax treaties involved. So obviously, it was a Herculean task for Supreme Court. There were various senior advocates, including Mr. Datar, Percy Padiwala. So a lot of senior advocates appeared for various taxpayers and argued before Supreme Court. So for ease of reference, what Supreme Court did is they categorized all the business models into 4 categories. And I've just put a diagram just to explain what was the distinction of those 4 categories. So one was your simple model where, as an end user, I purchase, let's say, Microsoft Word, Excel, any other software from them directly from Microsoft Corporation USA, for example. Then that was like category 1. Let's say today you have a situation where, and we have seen this practically, where you buy a CD or you have Microsoft India or any third-party channel partner of Microsoft selling that license to you. So that is category 2, where you have the non-resident entity selling that software license first to a distributor, and who is intent reselling it to end customer, whether it is an individual or corporate in India. So you have a layer in between. Then the category 3 was the US entity or any other entity for that matter, who is the software license owner, having a foreign distributor who is then reselling into India. And the 4th category was like a IBM kind of situation where they are selling, or a Dell, or for that matter, any hardware company, bundling the software and selling that product to you. So these were the broad 4 categories. And now you will be able to connect the dots when I discussed about business models, that the emerging business model per se were not present before the Supreme Court, because they were batches of appeals which were clubbed over a period of time. So models like SaaS or cloud, those are models which were not specifically discussed in the Supreme Court ruling. And how do we apply Supreme Court rulings principle on those models also is something which we will discuss as we move now. So That's like the broad categorization which Supreme Court kind of put in when they started evaluating. Another dimension which Supreme Court also, when you read the ruling, you will find is they spend a lot of time looking at what exactly was the agreement with the end user, or for that matter, the distributor, in all these four categories, to evaluate whether really they satisfied the definition of royalty. And typically, I've just put them in four buckets. They went through some 7-8 agreements, and they are reproduced. Those relevant clauses of the agreements are reproduced in the Supreme Court ruling. But broadly speaking, they made these observations that if you look at all these agreements, these were the common four themes which were present in all these agreements. Typically, for the end user who was accessing these software licenses from the software seller, the non-resident software seller, typically the non-resident software seller gave a non-exclusive, non-transferable right to either the end user or the distributor to resell computer software to end customers in India. They also noticed that there were clauses in the agreement, and I have more detail on the subsequent slide, that the copyright was specifically non-transferable, as in typically when we read the ruling in detail and various other precedents, there is no definition of copyright per se. So when we look at how copyright is perceived under the copyright law today, it is a negative connotation to say that what are the situations where it will be construed as copyright is breached. And therefore, when Supreme Court kind of evaluated, they looked at, what are the rights which are given by the software seller to the distributor, or for that matter, the end user, and whether that met the negative test in terms of breach of copyright, and therefore whether it resulted in transfer of copyright. So again, I'll just quickly move on to the next slide where you will understand this aspect in greater detail. Just look at this slide, and these were the typical clauses which you will see in the end user license agreement. And if you look at the table here, I have put it in 3 buckets. So the bucket number 1, which is on the left hand side, is typical nomenclature of that clause. This title may change, but in substance, this is what typically would be defined in the agreement. Then what were the key principles which Supreme Court kind of said we need to look at, and what was the language, for example, in the Samsung agreement, which was there before the Supreme Court. So what Supreme Court said is that in case of grant of license, typically if the end user is granted only a limited, non-exclusive and restricted license to use the software as an end user, then that would not satisfy the definition of royalty. And if you look at now on the right hand side, Samsung also kind of granted a very limited, non-exclusive license for installing, using and accessing and running that software either on your mobile phone or on your computer, depending on where you are using that software. So that is where Supreme Court kind of draw the analogy to say that here really what is being given to customer, or when I'm buying that license, I'm more interested in using a copyrighted article rather than exploiting the copyright, which is a different business model, and that was not something which is really relevant in the current fact pattern. Then they looked at other clauses also, where from a holistic perspective, that what are the rights really which are being transferred. And typically they said if you look at these kind of agreements, you will specifically find that the intellectual property rights or the title of software will continue to remain with the overseas entity. And those rights, in fact, will be expressly not granted to the end user from a legal perspective, so that there is no dispute from a legal perspective, and that legal law is nothing but the copyright law, and therefore really there is no right per se in terms of any legal rights being transferred from the foreign entity to the end user. There may be situations where some rights are transferred, but if you look at those rights, what are those rights? Those rights are typically rights where I am either given rights to use the software as an end user, or maybe some limited rights like making backup copies, because my data may be stored on that software, And tomorrow, I don't want a situation where if there is a crash of a system or something else, then I'm struggling to recover my data from the software tool. So those kind of limited rights are given. Typically, also, if you look at bucket number 3 on the slide, they will also put caveats around restrictions on making copies, modifying the software, doing any kind of uh, change in the source code of the software. So that will be considered as a breach. So these clauses are also there specifically in the end user license agreement, or the licensing agreement which is given to the corporate buyer. So if these kind of clauses are present in the agreement, then typically it would not be construed as uh, transfer of copyright, but it would be more construed as if it is being considered, it will be a uh, sale of a copyrighted article. So, this was the direction in which Supreme Court kind of concluded. Now, let me spend maybe 2 minutes on the key takeaways which we had from the Supreme Court ruling. So, what did Supreme Court, looking at these various clauses, judicial precedents, kind of upheld? So they said, when we look at the underlying substance of these transactions, you don't really need to look at the nomenclature of the agreement. See, typically, what happens is you get colored by the fact that it is an end user license agreement. The word license creates a controversy in the mind that both act and somewhere in the treaty, also in some treaties, you have granting of license as a word, and therefore it is nothing but transfer of copyright or granting of license, and therefore it is taxable. But Supreme Court said that end user is not getting any right in the intellectual property, and therefore when we read the treaty along with the Copyright Act, we don't see this fitting into transfer of any copyright, and therefore, according to us, this is not really taxable as royalty. This is purely a business income, and if while they didn't mention this, but as a general principle, if there is no permanent establishment, then the business income typically is not taxable under the domestic tax laws, or for that matter, tax treaty. They also made few interesting observations around India's reservation on the OECD commentary. So when we read the OECD commentary around Article 12 of royalty taxation, we will find that they also had advocated this theory of distinction between copyright versus sale of copyrighted article, and they kind of concluded in the OECD commentary that typically in these kind of situations, you will most likely conclude that it is a sale of copyrighted article rather than transfer of copyright. But India kind of had reservations to that OECD commentary, and they said we don't agree with this position. To which Supreme Court categorically made an observation that India's reservation to OECD commentary does not have any relevance until government takes cognizance of those reservations and does something in terms of amending the tax treaty. Merely amending the domestic tax law is not good enough, especially for taxpayers who have access to tax treaty, and therefore the position really does not change whether you make changes in the domestic tax law or you have reservations to the OECD commentary. So that is where we stand today on how Supreme Court looked at this. Now, logical questions to come, do come to our mind when we try to think about this vis-a-vis, the business models we discussed, and when we move to case studies, we will spend some time on how to apply the Supreme Court ruling on a SaaS model or any different kind of new age business model. So that again would be interesting, and I'm sure everybody would be excited to apply your mind on that case study, and then we will debate and maybe try and see if we can get some consensus on taxability of those kind of transactions. Now, what I will do is, now that we have discussed taxability as per the royalty provisions, another aspect which we discussed was fees for technical services, especially if we have a composite contract of software license and services or a separate fees. So, that is not, to my mind, very complicated. Typically, the way you evaluate any fees for technical services, those principles will apply here as well. So if you have a tax treaty which has clauses like what we have in typically a USA or a UK treaty, which has something called as make available, and I'm sure you would have heard about the make available clause, which is there on the slide. Uh, Typically, what we mean here is that when we define or when we look at the definition of FTS, it has typically 2 or 3 components depending on the treaty. So it will have technical services, it will have consultancy services, and it will have managerial services. Generally, the treaties which have this make available clause, you will see that the word managerial is missing, except for Netherlands treaty, which has make available and managerial word as well. So these concepts are not defined, managerial, technical, or consultancy, but you will find a lot of judicial precedents. And again, to put it simply in a context of software licenses, where you are provided implementation support or post-sale services or troubleshooting services on a case-to-case basis, you will have to evaluate these clauses to come up with a conclusion. So to give an example, if SAP is helping you with implementation of SAP and also doing a knowledge transfer of how to implement that in future, potentially a make available definition will also get satisfied, and in those situations, those services will become taxable. But if there is a software vendor who is helping you only with implementation and not really doing a knowledge transfer, and he has access to this treaty, potentially you may say that make available test is not satisfied and therefore that service is not taxable. So again, on a case-to-case basis, you will have to evaluate this and take a position. So that is how you will broadly look at royalty and FTS for these kind of remittances. Now let's close the loop and look at what the foreign entity is required to do. All these foreign entities, including the IBMs of the world, Microsoft, who were there before Supreme Court, are we saying therefore that after the Supreme Court ruling, they don't need to pay really any taxes in India, as Supreme Court upheld that these kind of transactions are not really subjected to tax in India? The answer to that is not a clear yes, and I'll explain why. One is obviously equalization levy. Second is, if they have presence in form of sales and marketing team in India, either through a subsidiary or through a distributor, again, you have to evaluate whether that entity is resulting in any agency fee exposure and what could be potential ramifications for that overseas entity in India. But keeping that agency fee topic aside, let's discuss what is this whole equalization levy tax. Now, I'm sure you would have heard that government had introduced equalization levy tax twice. Once in 2016, where they introduced this tax only on advertisement related services, where it was a 6% withholding tax, though it was named as equalization levy. So there they had introduced that tax specifically to target digital advertisements, and again there were certain conditions which were kind of put in those legislations. And in the initial period, government did not see so much of collection on that ground, but from 2017 to 2020, they saw around some revenue from that tax. But come 2020, when the global platform of OECD and G20 was discussing BEPS 1.0, which I had mentioned at the start of my session. When BEPS 1.0 was released, and it was noted that they could not conclude anything on digital economy. In that position paper, they had evaluated equalization levy as one option for levying taxes on digital economy. And as part of the global consensus, it was agreed that equalization levy may not be the correct method. But it was also mentioned in that document that in the interim, if some countries feel that there is a significant tax leakage, they can consider introducing this tax in their domestic tax law. And that is where we saw, equalization levy being introduced in India on online digital services, or for that matter, the digital economy, apart from the digital advertisement. And we also saw a lot of European countries like France and few other countries introducing digital service tax. So it was not only India, but a lot of countries, introduced uh, this kind of tax that point in time. So that was because of the discussion which was happening at the international level. Now let me spend some time on what this tax is all about. This 2% equalization levy tax. So if I have to summarize this whole tax in one slide, this is what I've done here. There are 4 tests which one has to look at to conclude or to decide whether this tax is applicable to you or not. And again, like we discussed, this is applicable only to a non-resident entity earning income from India. So just to ensure that they are focusing only on high value transactions, they have put a threshold of 2 crores. So if there is a non-resident entity doing one-off transaction in India and or dealing with customers which the business is very small, that is, it is less than 2 crores per year, then they don't really need to worry about this tax and they can continue doing that business. It's only when the business crosses 2 crores, that is where you have to evaluate this equalization levy tax. And again, this has to be evaluated only if you have concluded that your income from business in India is not effectively connected to any permanent establishment in India, which you have, or it is not taxable as royalty or FTS under the domestic tax law. And it is very logical because the tax rate on royalty and FTS would be minimum 10%, and this equalization levy is only 2%. So that therefore the sequence which we have to apply, which government has recommended, is that first check taxability under royalty or FTS. If you are concluding that the income is not taxable as royalty or FTS, then you have to look at equalization levy. Now, assuming that this is not taxable as royalty and FTS, we will now look at the equalization levy test. So what are those tests? What we have to check is whether that non-resident entity is a EOP, that is a e-commerce operator. Now, when we hear this terminology, our basic gut feel says that, okay, e-commerce operator means, are you talking about Amazon or Uber? Because, those guys are typically who are e-commerce operators who own a platform and they provide digital services to us. And therefore, prima facie, everybody felt when we heard this terminology that, okay, this is only for, service providers who use an app or a tool to provide a service. But really, when you look at the definition, it is so wide that it is all encompassing, and it's not necessary that it only covers service providers who are providing services through an app. And I'll explain that. When you look at the definition, it says that non-resident who owns, operates, or manages a digital or electronic facility or a platform for online sale of goods, online provisioning of services, or both. So, here it is so wide that, let's say, let me give an example that today you see so many companies who provide software license to their end customers just to facilitate quick sale. They provide you a facility of buying software online. So you can just go to their website. If you like the software, you click a button, you make the payment, you get the key, and you immediately download or you start using the software on cloud. But here, when you download the software, you are actually using the software on your laptop, and therefore it's not like a app where you are using services digitally. And therefore there is a debate, or that question comes to your mind, that whether there is really, in that situation, whether that non-resident entity is a EOP. And when you start thinking about it more, you will feel that, yeah, it may potentially qualify as an EOP. And what we will do is that when we discuss case studies, we will spend some time on how to examine these tests for conventional models also, and for new age business models as well. Then the next test, which once you satisfy the EOP definition as non-resident, what they are saying is that the non-resident has to see whether he is also satisfying the ESS test. That is, you are doing an e-commerce supply of services. That is, what does e-commerce supply of services mean? It is not just Amazon selling goods to you online. But what they are saying is that online sale of goods owned by the e-commerce operator, online provisioning of services provided by e-commerce operator, or you facilitating. So typically, this is what an Amazon business model would be. But if you look at the table below, which I have presented, they clarified the scope of this via Finance Act 2021, where they said online sale of goods or online provision of services also includes acceptance of offer of sale, placing of purchase order, accepting of purchase order, making payment online. So if you're doing any of these activities also online, that would qualify as ESS. So they kind of widen the scope of ESS to such an extent that not only the full life cycle, but even if one step of the life cycle is done using an online service, then it will qualify as ESS. So you can now imagine that it will be very difficult for any taxpayer to get out of the definition of ESS. But again, therefore it's a tightrope rope. And when we discuss case studies, do we have any situation where we can get out of this is something which we will maybe spend some time on. And then we have the last bucket, that who is the service recipient. So typically we will think that, okay, logically this should be NR to R kind of situation. But if you look at here, they've also covered these two additional situations, which are very interesting, where they're saying that even if a non-resident is doing business with another non-resident, where it is specifically sale of advertisement related business and the end user is in India, or let's say a US entity is providing services to another European entity, which is selling products which are also accessed by a customer in India using an IP in India, and a sale is concluded. Even in those situations, if the turnover is more than 2 crores, then that transaction has to be evaluated from an equalization levy perspective. So this is another interesting aspect that a lot of times businesses miss out, that if their group entities are doing business directly with customers in India, then this aspect has to be evaluated in greater detail. So, I'll just, I'm just looking at the queries. Nitin, if it is okay, I will cover these queries when we discuss case studies. Let me just quickly move on to the next slide. After we have understood the concept, now let's look at how has the industry reacted on this. And again, the reaction comes from compliance, and that is where I thought, let me put this slide to give you some perspective of what exactly has happened. So like I was telling you earlier, we had the digital equalization levy tax, which was not on software license, which was more on advertisement related revenue. So that tax was there till 2020, and it is there today as well. But if you look at the collection trend, in first year, government collected 200 crores of equalization levy, which was at 6%, by the way, and it went up to 1,000 crores, roughly 1,136 crores by 2020, and this was that 6% tax. Then government also introduced this 2% equalization levy tax. While the data of financial year 23 is still not available in public domain, maybe in next 15-20 days, we should see that information in public domain. But the latest information which was available was March 22. And if you see that number, it has gone up to 3,900 crores. And obviously, this jump is primarily on account of this new tax which was introduced in 2020. And mind you, as you are aware, this is only a 2% tax. So if I assume that the growth of roughly around 2,000 odd crores is all attributable to this new equalization levy tax of 2%, then if you have to just gross it up, it will roughly translate into a 50,000 crore turnover on which this tax has been paid, which is roughly the digital economy revenue on which this tax has been collected as of now. Now, while 50,000 crore looks a good number, but somebody could also say that it also looks a small number, because the kind of volume which we see in digital economy, there is still a lot of potential in terms of tax collection. So maybe some players have already started paying tax. Some players continue to offer tax under royalty FTAs. Some players are still evaluating, we don't know what kind of things are happening at the background, but I thought this would be a good information for sharing with all of you. In terms of the geography within India, if you look at it, Bangalore is leading the charge. So while most of us are in Pune and in Maharashtra, Bombay has some share, but we are not seeing so much of collection from a Pune jurisdiction perspective. But mind you, most of these foreign entities, when they apply for PAN, they also put their address of overseas location, and therefore that tax collection potentially goes in Delhi jurisdiction and not in Pune. So you may have situations where a lot of these taxpayers are based out of or having representatives or present across country, but just having their PAN in the jurisdiction which is mentioned on the slide. So this is just a general information which I thought I should share with all of you. So moving ahead quickly on, this was the local version, or a perspective of what India is doing in the interim. Now let's just spend maybe another 5-10 minutes on what we discussed about what is happening globally, and what exactly is this BEPS 2.0 pillar 1, which I was discussing. Sometimes these jargons are a bit heavy duty, but let's just dissect them in brief to understand what exactly is happening at the international forum. So like I was mentioning to you, this BEPS 2.0 was initiated after there was a failure on BEPS 1.0 on taxation of digital economy. So therefore, they kind of said that let's spend some fresh energy or time on deciding how do we go about this. And if we start reading about it, you will find that the debate was more primarily on account of the fact that these business models are very different than your conventional manufacturing operations, where you can allocate tax revenue to a particular source country basis operations in that jurisdiction. Because what you have here predominantly driving revenue is the consumer. And if you look at the conventional PE definitions, they are not consumer driven. They are more driven by your physical presence or your concluding of contract or your rendering of services. So that is where they felt that we need to go completely back on drawing board with a new approach altogether to tax digital economy. And considering the fact that this will be a new approach, they also were mindful that we cannot implement this across the board. And therefore, whatever we are discussing, you will see on the ensuing slides that this initially will apply to only big multinational enterprises. So today, most of us, when we will be dealing with real life situations, and when we look at the thresholds also, you will realize that today this will not be applicable, but over a period of time, this potentially may apply to all entities. And that is where it is good to know that what exactly is OECD thinking. And by the way, India was also party to all these discussions, being a G20 member. And most of these countries have given a consensus that they agree with this approach. So sooner or later, we will see some flavor coming around this in some fashion in the Indian domestic tax law and through also changes in tax treaties or multilateral instruments. So we will spend now some time on pillar 1 on what exactly they have discussed and suggested. So what they are saying is that we need to move to a new nexus model, which is nothing but market jurisdiction model. Because what happens in typically a digital economy is that you may have your IP, you may develop a product in your home country, but what is driving your revenue today, once you have already developed a product, is the sale in the market jurisdiction. And therefore, the market jurisdiction should get its fair share. After a lot of debate, they kind of concluded that we can't have a situation of your typical transfer pricing model of a FAR, where we will look at functions, assets, and risk in the source country and then do a profit allocation to the source country, because those kind of functions are not performed in the market jurisdiction by digital companies. So therefore, they said we have to go with a ad hoc arbitrary percentage approach. And how that is to be done, I will just discuss that in the subsequent slide. So therefore, they define that as amount A. They also acknowledge the fact that these MNCs sometimes have a entity in the market jurisdiction and sometimes they don't have an entity in market jurisdiction. So in situations where they have an entity, then in that situation, there is amount B in terms of certain baseline for marketing and distribution activities which are taking place in the market jurisdiction. So what this means exactly is again something which I will discuss briefly. And there was also a lot of emphasis on this being such a complex topic that there should be a mechanism to ensure that everybody is on same page, whether it is the taxpayer, whether it is the OECD, and whether it is the local government. Because unless we do that, we will again get into a Pandora's box in terms of a new litigation. So tax certainty is another pillar, which is of focus or a key driver on this. So like I was mentioning, pillar one's objective in the new nexus rule acknowledge the fact that physical presence cannot be the basis for taxation, and therefore you have to reallocate or change the way the taxation will be or the tax collection will be kind of distributed, and therefore they concluded in favor of market or user jurisdiction. And like I mentioned, they said that normal TP principles will not be relevant, and therefore we need to look at more of arbitrary allocation. So if you look at this slide, again, just not spending too much of time, but briefly, they kind of said that we, under the amount A, what we want is new taxation rights for the market jurisdiction. So let's say today a US company is earning digital revenue more from India, but not offering any income to tax in India, then that is not acceptable. If the customer base is in India, then you have to have a situation where equal share of revenue is also given to India, especially if you are making abnormally high profits in your home country, or for that matter, at a global level. So that is where they have moved significantly from the traditional way of taxation, because traditionally what we used to do is we look at entity level PAR analysis or entity level taxation. Here they are saying that we will look at it at a group level. We will look at what is happening at the HQ level and then allocate it across the board. So there is detailed draft guidelines around this. If you want, you can read that in public domain. This is, by the way, still draft, so a lot of fine tuning will happen over a period of time. So not spending too much time again on how the mechanism will work, because this is still on drawing board. Now, like I was telling you, what has also been acknowledged by OECD is that the business models are changing at a very rapid pace. And if you remember, we discussed on the first slide that they are looking at digital services into two buckets. One is the consumer facing business and another is automated digital services. So what are these business models according to OECD? What they are saying is that typically when you have some human involvement where the digital services are not delivered automatically. Like for example, when you have online advertisement on Facebook, really once the algorithm is set, there is no human intervention in rendering those services or licensing the technology, and therefore those kind of services will fall under the automated ADS category. Whereas wherever you have some human involvement, then typically that will be CFS. And again, per se, that does not change anything in terms of taxation. This is just a classification for for understanding these business processes. And again, without getting into too much of details, I will spend some time on the next slide where we will understand the thresholds, because that is where you will understand today this is being targeted only towards big MNCs, and in future it will become relevant for small companies which are relevant or having business in cities like Pune and rest of Maharashtra for that matter. So if you look at what kind of thresholds today we are looking at, so they are saying that today we are targeting MNCs which have a global turnover of more than 20 billion euros. If I have to just roughly translate this today using the exchange rate of euro to INR, this translates into 1,78,000 crores. Now, if you look at this number and just start thinking in India, which will be the group which will really meet this threshold, just from a benchmarking perspective, because obviously we have to look at these thresholds from a foreign entity perspective, but not a Indian entity perspective. But just an example, only Tata or Reliance Group will breach this threshold, and no other group will really breach. So, from a US or from a Euro perspective, also typically what is expected is only maybe not more than 100 to 100 companies would really meet this threshold. So that's the target, because they believe that these companies have profit margin of more than 10%. In fact, officially, OECD in its press release has also mentioned that they are expecting more than $100 million of unlocking of revenue for countries across the world because of this new taxation regime. And obviously it's just a guesstimate. Time will only tell what exactly will happen, but that's like a number which we are looking at. Once that M&E level turnover is breached, or you see a M&E where they are having this kind of turnover, then the second criteria which has to be applied is that what is the business which you have in that market jurisdiction. So that number is comparatively smaller. So for example, let's say Microsoft will logically breach this turnover. So let's say Microsoft is having a business of more than 1 million euro, which is only 89 crores, which most likely will get satisfied. Then they will have to, look at what is the impact under the pillar 1 in terms of taxation on their business in India, assuming we will cross 40 billion euros of GDP by then. Anyways, if we are less than 40 billion that point in time, then the threshold reduces. So it's not that India will never, or Indian market will never be subjected to this kind of taxation. We will always be there. It will only depend on which bucket we will fall on. So when this tax is introduced, all the countries have agreed that for entities to whom pillar 1 will be applied, equalization levy will be withdrawn. So we will have to see whether the government will withdraw equalization levy altogether for all taxpayers, or will they say that no, we will do it in a transitionary phase. We will initially withdraw equalization levy only to entities to whom pillar 1 taxation will apply, and for other entities, the 2% equalization levy will continue until the threshold is reduced globally at to a lower level of, let's say, $10 billion or 10 billion euros, or for that matter a lower amount. Now, the interesting question will always come that how will the OECD or everybody in the globe implement this, because like Supreme Court said, until you change the tax treaty, you cannot tax the taxpayer. So what was the consensus at BEPS and G20 on this? So basically, what is going to happen is that OECD is going to come up with these things. They are going to suggest language which will be modified or which will be introduced in the domestic tax law, and they will also have a new multilateral convention like we had the MLI. They will have a MLC, which can be signed by all countries, where they want to implement this in one shot, amending all the tax treaties. And therefore, like we read today the MLI with tax treaties, we will also read the MLC with tax treaties, and you don't really need to negotiate bilaterally, but on a multilateral basis, your treaties will change, and they will also have rules agreed on the profit allocation and tax allocation across countries. So that is how they are expecting to implement this. There is information in public domain initially in 2020 that they were planning to implement this as early as end of 2023 or during 2023. But as of now, since we are in April, it's a very challenging timeline. So we'll have to keep watching this space in terms of how this will be implemented in due course. So I hope this is clear to most of you. I have noted, Nitin, your questions. After the case studies, I'm sure we'll have some time, so we'll spend some time on your questions as well. So what I plan to now do is, now that we kind of know all the gamuts of pillars or gamuts of how the taxation will work today, what is the future looking like? We have the equalization levy tax today. So in terms of real life situations which you have today, primarily assuming that the entity does not have a permanent establishment in India, it has access to treaty. Therefore, Nitin, to your question that we don't need to really look at significant economic presence related rules. I will spend some time on case studies where I will want you to also apply your mind on real life situations to examine those transactions from a royalty, FTS, and equalization levy perspective. So I hope everyone is kind of geared up to look at, or evaluate that. And maybe just one question to the organizing ICI team. Is it possible for any participant to give an answer, or they will have to only give an answer through chat? Rishikesh or ICI team, if you are online. I just had one question that, let's say, when we are discussing the case studies, if some participant would like to give an answer, is it possible for them to unmute and give an answer, or they can only answer?
Yeah. The participants can raise their hand and I'll unmute the participants.
Okay. So what I'm thinking, and if it makes sense, Rishikesh, is that if anybody would like to attempt answering a particular case study, then we will give them that opportunity. And obviously, I will give my answer, but hopefully that will help them to see whether they are able
let us keep the session interactive.
Yes.
Yeah.
So let's look at this case study number 1, and don't get afraid with the diagram or the content. It's a very simple case study, but I've put some bit of complexity because this is how the real life is, right? When we have remittances, we face this situation. So let's just understand what is happening here, and then we will come to the implications. So here we have a situation where, let's say you are the Indian entity. Now you are wanting certain software licenses for your business team. So let's assume you are an IT company, and on a day-to-day basis, your employees keep asking for software licenses because they are doing software development work. And everybody today, or generally also in past, wants to ensure that there is cost rationalization in terms of ensuring that we don't spend too much unnecessarily on any procurement for that matter. So typically what we see therefore is that multinational groups kind of do contracts with their third-party vendors at a global level. So let's say you are buying licenses from Microsoft, you're buying licenses from any other third-party service provider. Typically, they will try and see if they can sign up a deal globally so that they get a best deal. And then those software licenses on need basis are provided to employees across the globe. So similarly, here in this case, the way this group has put in place a structure is that employees across the globe, including India, can go to an internal app store, and on this app store, which is hosted, let's say, on either a server which is owned by that group. For this example, let's assume that, or a cloud, but let's assume for this example on a server which is hosted in the premises of parent, and on that server, on that website, all these products are hosted like a catalog. And let's say today I want to buy a Adobe software to do some editing of a PDF document, then I have to make a requisition, or I have to click or add that software to the cart and buy it. Let's say it will go to my senior. If he also feels that, yeah, there is a business necessity and whatever request Mitesh has made is a valid request, it has to be approved. So he'll approve, and at the back end, the software will be purchased and installed on my desktop. Okay. Here, that's like the broad nuances of the modalities. Few other things which I've also mentioned here is from factual perspective, which is just for your information. Also, from a completeness perspective, to ensure that when we have to evaluate royalty taxation, I have given the terms of what are the terms for the end user license agreement with between my UK entity and the third party license provider. So you have all the facts which I believe are relevant for evaluating royalty, FTS, and equalization levy. What I would now want is if somebody would want to give it a shot to say that what is their view on this kind of arrangement. I think Rishikesh here will need your help.
Hello.
Swati madam, can you just unmute the participants because I am unable to unmute them.
Okay, sir.
So I was able to unmute Sudhi. Sudhi, you can unmute and maybe share your thoughts.
Yeah. Hi, Mitesh. So for this question, if you look at the facts, this would not be taxable as royalty or FTS because if you look at the terms of the agreement, it is a non-exclusive license and there is no right in the software that is transferred to the end user. They are only allowed to probably make a copy only for using it and no rights as such are transferred. So no, it will not be taxable. And for the equalization levy, well, I don't have any practical experience, but going from what you just explained, since they are just recharges made for the cost, eventually this is not going to be revenue for the non-resident. These are just recharges and, they must be attributing the cost and the cost must be going from India. So I don't think there should be any equalization levy as well.
Okay. Thanks, Sudhi. That's good to know. Maybe Nitin also wanted to chip in, so I will just allow Nitin to first talk and then maybe I'll share my thoughts.
I accept the view what she has endorsed, but probably transfer pricing implications with the markup would get triggered in this particular transactions, and according to that, the compliance has to be done.
So Nitin, just for benefit of all, when you say transfer pricing on markup, are you referring to the recharge which PLC is doing to India?
Yes.
Okay. So your question is more around from a transfer pricing perspective, whether PLC when they are recharging, whether they'll apply markup or not.
Yes, that will happen because the previous participant has already said it is not a royalty or a FTS, which I endorse. And according to me, equalization levy also will not trigger. So since it is a related party transaction, so probably that will transfer pricing and the markup will definitely trigger within this particular transactions.
Okay. So good to know both of your thoughts, and maybe if anybody else would like to chip in, otherwise maybe let me spend some time. So I think we don't have any other participant as of now raising the hand. So Sudhi and Nitin, on the first part, I would agree with both of you on the royalty taxation bit. Primarily basis the terms of the agreement which are put on the slide. So here there are two interesting aspects which I would just want to highlight. One is if you look at it today, there will be two agreements here, assuming that there is only one third party vendor. One agreement will be between PLC and the third party vendor, and there will be another agreement between PLC and India for recharges. Now, in that agreement, like Nitin was mentioning, the cost recharge will be agreed, what we have seen practically is that some groups like to charge a markup, some groups don't like to charge a markup, and because it's a cost for India, as long as the transfer pricing regulations of the overseas country are okay, you will have both situations, and we have seen a lot of overseas groups coming back to us and saying that we are okay if we don't have a markup from our transfer pricing perspective on these kind of recharges. So, one debate which always comes up is that, do I need to look at the terms of agreement between my parent and me, or do I need to look at the agreement between PLC and third-party vendor? So, like Sudhi and Nitin mentioned, I think a better point of view here is that we should look at the agreement between PLC and the third-party vendor, because that is where the terms of software license really come out, and therefore, as long as they are matching with the Supreme Court ruling with respect to licensing, we are good to go. And here, assuming it is a conventional license, that should be fine. Now, on equalization levy, if you remember, we had spent a lot of time on discussing the changes which were brought by Finance Act 21. And that is where maybe I'll just quickly, for benefit of all, just go back to that slide. Just give me a minute. So, if you look at it here, when we look at the definition of EOP or ESS, okay, so when we were discussing ABC PLC in our case, which is our UK entity, and if you look at the EOP test first, one will have to ask a question that, are we satisfying any of these tests? So is PLC a non-resident? The answer is yes. The question is it owning, operating, managing a digital platform for providing online goods or services? Now here, if you look at the definition, it does not say that I need to be the seller. As long as I'm owning a platform where such online sale of goods or services is happening. So, typical Amazon kind of model where Amazon is a facilitator and it's not actually buying and selling goods to end customer, is also something which is potentially covered in the gamut of equalization levy, and therefore your PLC entity potentially could satisfy the EOP definition, is my point of view. And then once I am kind of owning, operating, and managing that server where this is hosted, where eventually a product of Microsoft is sold, I am kind of satisfying EOP. Then because I am facilitating that sale, potentially I am also satisfying the ESS test. And because the buyer is a resident entity, the ingredient of last bullet is also getting satisfied. Some of the aspects like acceptance or placing of the purchase order also in that case happens through the ERP, which I discussed, or the portal in this case, which is a platform hosted here. And therefore, at least, the way I am looking at it, and contrary to what Sudhi or Nitin felt, I kind of feel that here equalization levy potentially will be applicable. And this is the snapshot of each test which was evaluated by me from a factual perspective here. So does that help you, Sudhi and Nitin?
Yes.
Yeah. So we will come to one more case study where we may have a different conclusion, but for this fact pattern, at least my point of view is that the foreign entity will have to pay equalization levy. Another interesting dimension is that, can this foreign entity check with the third-party service provider whether he's paying equalization levy in India for these kind of sales? Because if you remember, when we discussed the equalization levy, last bucket, which had not only resident as a recipient, but other non-resident also as a recipient. So the question is, can you ask Microsoft that are you really paying equalization levy on this sales which are happening to India? That is point number one. Point number two, can I put that in the contract with Microsoft when I'm signing this contract globally and put the liability on them? Because otherwise this becomes a cost of doing business in India. Because if you look at ABC PLC, technically it's not their business to really sell the software license. They are just doing this as a centralized facility to get a better deal from the third party vendor. But when our legislators are drafting the law, unfortunately they are drafting it so widely that a lot of situations which otherwise would have not come into the gamut of these kind of taxes potentially end up getting into this gamut.
So Mitesh, I just have one point. Can I ask you?
Yeah, go ahead.
Okay, so in this particular case, when you say it falls in these tests of equalization levy, so then essentially what is happening is the non-resident entity, which is ABC PLC in this case, is also going to be paying 2% of the cost recharge that they are extracting from India, right? That's what you're trying to say.
Yeah.
So then, but they are not essentially providing, selling anything or providing a service. Group companies all over India and across the world have applications that they procure and transfer. So then does it make sense for MNCs to not cross charge the cost then?
Yeah, so see, that's a very good question. There are 2 points here. See, one is the tax authorities will argue that had you purchased it directly from that third party vendor, what would have been the position? Again, there are pros and cons to that, and I'll come to that. And second is to your question that therefore, does it make sense for non-resident entity to not recharge? And that is where the point which Nitin mentioned could potentially come into play. So what happens is that when you look at transfer pricing today, specifically in technology sector, a lot of the entities which we have in India are captive centers, or what we call as global in-house centers or global capability centers, which primarily work for their parent, right? They work as a captive and therefore they bill on a cost plus basis to their parent. Now, typically when we do transfer pricing for them, and when you also have API discussions with tax authorities, they ask you this question that are you getting any free of cost services or assets or software licenses from your parent? If the answer is yes, then they ask you to add that to your cost base when they agree a markup from a transfer pricing perspective. So it becomes a double-edged sword for you from a transfer pricing perspective. While I will agree with you that I would not then want to recharge, but then transfer pricing will make it mandatory for me to recharge.
Fair enough, Mitesh. In case of captive companies, I completely agree. But like normal companies, IT companies, we cannot.
So as long as their transfer pricing position is supporting not recharging, they can take that call. So that's potentially a good solution until we have this equalization levy tax.
And companies are practically paying equalization levy on cost attributions currently, Mitesh? Practically, you've seen?
So it's a mixed bag. See, again, we will, let's complete the case studies and let's park this question because it's a very good question.
Sure.
And,
Can I just add one more extension?
Yeah, go ahead.
See, now with the amendment of the Finance Bill 2023, all the people who are providing the online services, especially called OIDR services, they are mandatorily required to under the provisions of the GST.
Yeah, but then again, within the OIDR are kind of relevant when you are selling to a non-GST registered.
Yes.
Right.
So in that case, the recipient will pay under the reverse charge, no?
Yeah.
So then where can it be termed as an equalization levy? That is another food for thought.
Yeah. It's a good question, but if you look at it and we have looked at this aspect. See, I'll give an example. In France, they called it as digital service tax. Okay, this tax was called as digital service tax.
Yeah.
But when you look at equalization levy or e-commerce equalization levy, whatever you may call this tax as, this came as Finance Act Amendment in 2020, and this was somewhere put in our Income Tax Act. It was not in the GST law.
Hmm.
So, and this also kind of came from the discussion which we had on BEPS 1.0, where equalization levy was specifically discussed as an alternative to digital tax and discarded as an option, but recommended as an interim measure. So somewhere all these things gives us a flavor that this is more like a substitute for income tax. And the fact that maybe I don't know whether government predicted that they will lose the royalty matter in Supreme Court in 2021. So they proactively brought this tax.
Okay.
So
Is
you
such
know, there-
concept, is
Yeah.
such concept available in any other country besides India?
no, no, I have not, frankly speaking, studied the France digital service tax, but whatever we have been hearing when we discuss with MNCs, the standard reaction is India is very unique. So to at least to the US counterpart, we tell them that we are unique like you because you are equally unique. Your tax laws are equally complex as ours. So that is how it is. And from a government standpoint, they want to ensure that they capture maximum tax base. Unfortunately, or fortunately, whatever we may say, they could have drafted this better, but a lot of representation has gone into this. I am just guessing that why government is not making too many changes is because they are looking at this like as an interim tax until BEPS 2.0 Pillar 1 is implemented. But to be very fair, looking at the thresholds in BEPS 2.0, one can safely assume that this tax will remain for a long time, and there is a lot of representation which is happening to make this simpler. But the tax collection today, that is why that slide was there, is like 4,000 crores. So maybe we will see what is the tax collection for March 23 and whether a lot of taxpayers have started paying tax, and maybe that industry potentially can also make further representations to simplify this.
Genuinely appreciated. Thanks.
So let's now move on to case study number 2, which is a new age business model. I thought let's complicate our life because unless we have complex situations, we'll not learn something. So this is a very interesting case study where what is different here is that you have an Indian entity which let's say wanted it had a business requirement, and I will use business requirement for a reason, and as we move along you'll understand why I'm saying that. So let's say they wanted a platform or an application for you have so many companies today who give you scanning services online or who do your contract management services online. So let's say you want these kind of services where they are telling you that, okay, don't worry, you don't need to really spend too much of money on infrastructure, because if you have to host our software on your server, you will have to spend money on server, you will have to spend money on infrastructure and stuff. So we are giving you a SaaS model. What is this SaaS model? This foreign entity is telling you that we will charge you a subscription fee per annum. And what is this subscription fee for? It is for using our platform. This platform is hosted on Microsoft Azure, which is a cloud platform of Microsoft. And you can go and access the software anytime from the cloud. We will also help you, initially build up or customize that application to suit your requirement, and we will also provide you support later on if there is any problem accessing that software. So that is where the facts are today for this case study 2. Now, therefore, the question which I would open the floor for is that before we look at something like a equalization levy, which we discussed, that in terms of hierarchy, we have to first look at whether this is taxable under the Act and the treaty, and then we jump onto equalization levy. So now I would want to open the floor, maybe factually, if you have any questions. Otherwise, technically, what do you believe? This is royalty or not? Or it is FTS, or it is not both?
It is not both. The reason is that subscription is only allowing you to facilitate the use of that particular processes. But that is not making you available anything. They are not training anything as such. So to my knowledge, it will not neither be a royalty nor be a FTS.
So this was Nitin, right, who was answering?
Yeah.
Okay. Anybody else would like to attempt? So they, I think, wanted to give it a shot.
Yes, Mitesh. So royalty, when you talk about, you kept using the word that it is only allowing to access it. Now, merely accessing the platform for the service will obviously not tantamount to transfer of any rights. So no royalty there, I think. And when you talk about FTS, let's keep make available aside for a second. When you talk about just pure FTS, well, I think it can be termed as a technical service being provided. If you want to remove it from the ambit by merely invoking the make available clause, then that is separately if you look into the treaty. But if you look at just pure FTS, I would like to categorize this as a very technical service. Yeah.
So Sudhi and Nitin, maybe let's debate this further to say that, let's say if this is a real life situation in front of you for this fact pattern, will you say that this has to be examined only as royalty, or it has to be examined as FTS, or both?
Both.
No, I will examine as a business profit.
That's a third dimension, but you are see, what I'm trying to ask here is that, see, typically when I have a business model like this,
Yeah.
Always a question comes to mind that, let's look at it from a FCO perspective. Am I a service provider, or am I a software license seller? Who am I? Or am I both? And again, I'm talking here more from a predominant business, predominant income perspective. See, I may provide support which is ancillary, but my main business obviously here is to, sell the subscription, right, of my platform. So what do you think? What is the main business of FCO?
The nectar of the business is to only provide the access.
I would say it's a cloud service provider, Mitesh. If I think it's a cloud service provider, and there's a distinction that
Sudhi, let me just give a dimension here, and then maybe your answer will change. There is another party in this transaction, which is Microsoft Azure, right?
Yes. So
to your point, actually, Microsoft Azure is the cloud service provider to FCO, and not FCO, because see, FCO's business is not to provide cloud. ऐसा रहता तो FCO would have set up its own cloud and charged customer for that. FCO is interested in selling software platform, and it does not want to spend money on hardware. That is why it has hosted that solution on Microsoft Cloud. So to your point, the cloud businesses of Microsoft in this transaction, which has to be evaluated separately. So I think this is getting interesting. We have few more participants who are raising hand. So let's allow Bhakti also to chip in.
Hello everyone.
Yeah,
hello Mitesh. So I think here only royalty will come into picture, because as you said that this is not the main business. I mean, I'm assuming here this is not the main business activity which is provided by FCO to anybody. Since Indian company is in need of something and they are assisting or helping to get it done, so it is just that it will come under the purview of royalty, but it will not be taxable as royalty, considering I think I may be wrong, I don't know, but considering this engineering case law which has come up, based on that, it may not be taxable as royalty.
So I think we have good inputs from all three of you. Thanks for that. And maybe let me just throw some light at how I'm looking at it, and whatever thoughts you guys have shared, they are very relevant and very pertinent. So just an additional perspective which I would want to add when we are evaluating these kind of transactions is that maybe we may want to ask the FCO some more questions, and also the ICO, in terms of what is their purpose here. So I'll just give you two examples, and this will be more clear. So let's say today as ICO, I come to know that there is this FCO who has a platform which will help me. And this is like a live case which I'd seen where there was this foreign entity which gave me a platform for designing my software on a cloud in a fashion where multiple team players can work on it simultaneously. So there, my objective of availing services from them is to use their software in such a fashion that multiple people can access the same file at one point in time. And therefore, in that kind of transaction, I would say that the predominant purpose is software license, and I will have to look at royalty. But let's look at another example where in a similar situation as ICO, I came to know about this FCO, which provides me goods report. So let's say FCO is into a business of scanning services where they kind of do a scanning of all my platforms, whether they are vulnerable to viruses or various things, and they give me a report. So here in this situation, what I'm interested is in that report, that whether everything is good in my place, because let's say I am an IT company and I have a contract with my customer that the data which they have given to me is secure, and therefore I'm availing services of FCO to ensure that the report gives me a clean sheet and that report can be furnished to the customer that don't worry, your data is secure. So in that situation, I'm really not interested in the software application or using that software application, but I'm merely interested in that service or the test report. So you could have that the kind of situations as well. So while predominantly we may have the first category, but you have to again on a case-to-case basis ask more questions and see whether it has to be examined from a royalty or a FTS perspective. And let's say if it is the second example where it is FTS, then if the treaty does not have make available test, then unfortunately it may become taxable under the tax treaty. So hope this helps everyone. Now, just moving on quickly on this same case study, I don't think we need to spend too much of time, but on equalization levy, what's your take? If anybody would like to give it a shot. Sudhi wants to give it a shot.
No, Mitesh, I think that was from before, but equalization levy in this case, since he is obviously selling a service online, I think from your past discussion, it can be attractive as per me. Yes.
Yes, same here.
Yeah.
I'm of the
You're
same
right,
opinion.
because this is like in our case study one where that third party was kind of selling it to my parent. Here this is because it is a direct model and everything is hosted on cloud. Most likely it will satisfy our test and equalization levy will have to be paid. But
Mitesh, what is the answer to the first question, royalty FTS? Can you just go back? You had probably written your conclusion. Yeah.
So on the royalty part, if the predominant purpose is royalty, then it is not taxable. That is what I think you guys had also mentioned. So even my analysis is same. And if this is because it is US treaty, I have mentioned that because of make available, this may not be taxable. But if it was some other treaty, potentially where there is no make available, it could have become taxable if it was a service.
Thank you. Yes.
So on that one, I think we are aligned.
Mitesh, can I ask one question?
Yeah.
So maybe it is repetitive, but this equalization levy of 2% is covering anything and everything,
Let's look at case number 3, Bhakti, and maybe your answer might change.
Okay.
So I was anticipating that we will have a question after case study 2, that is there any situation where I can get out of equalization levy? So let's look at this case study, and I'm not saying that we will get out of equalization levy here, but is there a possibility is the question. And there are too many facts on the right hand side, so you can, you don't need to read everything, but let me just explain what is happening here and what exactly is the business model here. So this is similar to your maybe situation number 2 or 3 of Supreme Court. Okay, so here what we have is that there is a US entity which is the license owner or the entity who is actually selling the software. But what they have done is that they have assigned their IP to an entity in UK. Like we had a distributor there, here we have a IP owner in UK. Now that UK entity is actually selling the licenses to everybody in the EMEA region, including India. So therefore, the US entity does not really interact with the customer in India, though they may eventually have an end user license agreement with the US entity. But for the commercial dealing, the Indian customer is dealing with either UK entity or the channel partner of UK entity in India. And because and again, I will not spend too much time here on royalty taxation or FTS, because we can safely assume that it is not taxable there, since we are more focusing on equalization levy. Let's spend some time on equalization levy, for which I've given few facts here. See, what is happening in this fact pattern is that when we look at those various tests of EOP, ESS in equalization levy, we need to look at various aspects of what is the online or digital element in this transaction. So that is where I put in some facts to say that when we look at their fact pattern, they generally sell their software because it's an enterprise solution. They don't sell it online, like you just click and buy. There is a lot of negotiation which happens offline, because let's say this is like an SAP where you don't sell online. You have to understand from your customer that what is the requirement, which modules they need, which version they need. So that there is a lot of offline negotiation which happens. So while the information about the product will be available on the global website, which is hosted by US, but a lot of offline discussions will happen. There will be negotiations which will happen, and then the contract will get concluded. So from a factual perspective, in terms of the online aspects here, my UK entity does not have too much of online presence. It may have a website, but the US entity has all the details available on the website and everything. Then when it comes to the transaction modalities also, most of the times when the UK entity is dealing with the customer, it is dealing through email. So there is an online element of using Microsoft Outlook for interacting with the customer, and all the discussion with the channel partner and customer happen through email, and then eventually the deal is closed. So let's assume that this is the fact pattern, and if we have to now go back to the equalization levy provisions and examine this, anybody would like to give a shot? What do you think, whether the tests of equalization levy will be satisfied? Yeah, Nitin, go ahead.
Couple of clarification required before I attempt the answer.
Yeah, go ahead.
Who is raising a invoice for the provision of such a service? According to what I understand from the facts, PQR US will raise the invoice, not the PQR UK.
So what? No. So what will happen here is that, see, what I have done as US is that I have licensed the IP with a one-time payment to UK. Okay. So what basically I've done is that I have told them that this is my IP, and you are hereby given a right to sell this software license in the European and Asian region, and you have to give me one-time payment for that. So let's say $50 million or whatever.
Okay.
And going forward, if you want any improved versions also, then you have to contribute to R&D. So I'm just sharing one additional fact that it's not like I'm selling some obsolete product to customers in India. They will get upgraded versions, and I will contribute to that cost. So from a billing perspective, I have no connection as Indian customer with the US entity. But in the end user license agreement, maybe US will be the party, because from a legal standpoint, US will want to be party so that there is no breach of copyright.
then in that case, it may get triggered under the equalization levy, because it will be ESS model, and equalization levy would trigger, to my understanding.
So Nitin, what I would want you to also think here, and you may be right, and we will come to the answer. But each of these buckets have to be satisfied. So let's assume that ESS is satisfied. But do you think any other test is not satisfied, or everything is satisfied?
First test has to be primarily satisfied, then only it can go to the equalization levy.
So which is the first test?
20 million.
Okay. So 20 million you can assume is satisfied.
Okay. Then in that case, to my understanding, all the conditions are satisfied.
What about the EOP test?
So in that case, PQR UK is not satisfying the test of EOP. It is not satisfying that test, but
so let's see.
We have to see the language, whether they have used the word and or in the definition of equalization levy. That will, if it is and is used, then all the conditions to be satisfied. If or is used, then either of the conditions.
And so, you have to satisfy all tests. Maybe let's hear from Sudhi if she has a different view. She has raised her hand.
Yes, Mitesh, how about the fourth bullet for online sale of goods or online provision of services or both? Why cannot it get covered here? Because you mentioned that PQR UK is going to enter into third parties. We've already concluded it is not royalty, obviously, because this is good copyrighted article. So why can't I say that it is providing online sale of goods?
So Sudhi, that's the point which we were debating between the discussion which we had with Nitin, to say that let's assume ESS test for a moment is satisfied, but we have to look at all these tests cumulatively, right? So the question was whether EOP test is also satisfied. And maybe Bhakti, you had also raised your hand.
So I'm talking about the fourth bullet in EOP, Mitesh, by e-commerce of fourth bullet for online sale of goods. No, the second box, the fourth bullet. Yeah.
Okay. But see, and I'll also allow Bhakti to chip in, but this has to be read holistically to say that a non-resident who owns, operates, and manages a platform through which he is doing this. So the question also is that whether UK is satisfying all these four bullets. And maybe let's hear from Bhakti. She has also raised her hand if she has a different perspective. What Bhakti?
So Mitesh, before answering question, I have one query. In this whole scenario, UK is a party who has got the license only, right? All the other things like maintenance or everything, it is not taken care of by UK entity. Am I correct?
Yeah, you're right.
So I'm into this second box and second bullet, owns, operates, or manages. So UK entity is not owning that software, neither it is operating nor managing it. So here itself we lose the essentials of applying this equalization levy from my perspective in it.
So Bhakti, you are thinking in the right direction. Now, another dimension is to also is to think from a perspective that because UK has such kind of role in this transaction where its role is more like a distributor or a reseller. The question also was that whether when I'm doing the transaction and I'm interacting through emails, whether that will result in I satisfying the EOP test. Anybody would like to think on that lines?
According to me, he may be satisfying the UP test because the agreement between the UK and US will have the binding impact for to all the customers what they procure. Such a website needs to be upgraded, or it needs to be provided with the latest developments or research, whatever is carried out. And there is an understanding between the UK and US to compensate each other, and in turn, they will get a compensation from whoever the customers who procure, who make registration on their website. That is what my reading is.
So let me now chip in with my thoughts, and this is like my personal view. I would say that we need to look at two parties here, and maybe let's focus on the UK entity first. Like Bhakti was mentioning, and I kind of personally feel that that's a better view to say that today the UK entity is not owning, operating, or managing any digital electronic facility or a platform when it comes to the software license per se, because anyways, like we discussed, this is an enterprise solution. I'm not doing any sales online, and whatever information also is posted online with respect to this project, and when the software download also happens, it is all on a facility which is owned, operated, and managed by the US entity. And therefore, from a standalone UK perspective, because this is a law where the law is very wide, I will do a strict interpretation and I will say that I'm not satisfying the condition. Now, coming to the role which I'm playing, where I'm playing a role of a distributor, my main mode of communication is therefore email. So the question which also comes is that whether the email platform is owned, operated, and managed by me, or in substance, whether the email platform really is a digital electronic facility or a platform. So there will be two debates there. So point number one on whether I own, operate. So Microsoft owns and operates, or Microsoft owns that platform really. I may be operating or managing it because I'm sending emails. But again, if you look at it, really I'm not owning or operating for providing the software license. I'm just using it as a mode of communication to correspond with my customer, which if there was no email, there would have been telephone, or if there was no telephone, I would have met that person and closed the deal across the table. So email is more of a communication rather than a digital platform, electronic facility is something which I can take as an argument. And therefore, at least my view on the EOP test for UK in this transaction is that I may not satisfy the EOP test. The question will always come, therefore, does that mean I can structure transactions in this fashion and get out of equalization levy? But that is where this last bucket where we have NR to NR transactions covered, the question will come that therefore, will this equalization levy tax fall back on the US entity? And that is something which one will have to again evaluate. There is a possibility that we may end up with a situation where we may have a potential exposure for US entity in this situation.
Will the exposure still be there in the absence of PE, Mitesh?
Yeah. So see, PE, you don't have a PE is an assumption in test number one. If you look at the box here, so it is always assumed that the non-residents involved in the transaction who we are discussing don't have a PE and they are not offering that income as royalty or FTS. Once these two conditions are met, then only we discuss equalization levy.
Got it.
So I think that hopefully helps.
By any chance, relationship between the US and UK, will it not be termed as a principal agent relationship?
So, that's Nitin, that's like a legal question. And see, even if it's a principal to agent or a P2P relationship, at the end of the day, I have done that. Let's say, when you ask typically these kind of groups that why you have done this, maybe they believe that from a legal point of view, having IP registered in someplace other than US is better. And maybe that is the reason why they have done this. It's not because from a tax perspective that they have done this. So there may be some commercial reason why they have put this kind of arrangement in place. Maybe they want to sell a particular geography business to somebody in future. There may be XYZ reasons why they are doing this kind of structuring.
Appreciated.
Yeah. And Nitin, you had asked questions around SEEP, but I would say SEEP would be relevant only in situations where we kind of have no access to treaty. So as long as we have a TRC, I think generally my view would be that SEEP would not come into play, and then we have to look at P declaration.
Appreciated.
So great. If anybody else has any question. Otherwise, over to ICI team, Rishikesh.
Just a sec, sir. Rishikesh, sir?
Yeah, I'm there.
Yeah.
So I hope the participants are pretty clear and all the concepts are clear. Okay, is the US company has been all the questions? Yeah. So we have done with all the questions in the Q&A box also.
Great.
Right. So let's conclude for the day.
Yeah. Sorry, just one.
Yeah, please.
People in audience wanted the PPT. I'll just check on that part and come back to you.
Fine. So with this, I thank CA Mitesh Thakkar once again for delivering a wonderful lecture and opening up the topic pretty in a lucid manner. I think the cases were starting at a lower what we can say degree of complexity and ending at a very high level, isn't it?
Yeah, I hope so. So
Yeah.
With 2 hours, I think that is what I could do as justice to this session.
Right. Thank you. Thanks again, Mitesh ji. Thank you all the participants for joining. And let us once again gather for the next session tomorrow. See you again. Thank you.
Thanks ICI team and audience for the patient hearing.
Thank you.
Thank you, sir.